Mark Brandon. It's my pleasure to be able to introduce tonight's speaker, Professor Harvey Rosen. Professor Rosen is the John Weinberg Professor of Economics and Business Policy here at the university. He was an undergraduate at the University of Michigan and received his PhD from Harvard. Professor Rosen has been a member of Princeton's Department of Economics since 1974 and has served as chairman from 93 to 96 and co-director of the Center for Economic Policy Studies since 1993. In 1986, he was elected a fellow of the Economic Society. Professor Rosen has been involved in both graduate and undergraduate teaching programs in Princeton. In recent years, he's taught undergraduate courses in public finance, taxation, and introductory microeconomics, and graduate courses in public finance. And Harvey told me that next semester he's got a huge class, so 300 or more students will be in one of his classes. He spent two different times down in Washington, D.C. working for the government. From 1989 to 1991, he worked in the U.S. Treasury Department as Deputy Assistant Secretary of Treasury for Tax Analysis. And his second stint in Washington just ended, I think, in July or August this year. He served for 2 years, from 2003 until this summer, on the President's Council of Economic Advisors, first as a member and then as the chairman of the council. And he stepped down, and another Princeton, a colleague of his, Ben Bernanke, became the chairman. And as I'm sure all of you know here at this group, Ben Bernanke is now the designated chairman of the Federal Reserve Board. At any rate, Professor Rosen's main field of research is public finance, and he is going to be speaking to us tonight on options for tax reform. Please welcome Professor Harvey.
Thanks very much for that kind introduction. I'm glad to be here this evening to talk about tax reform with you. And what I'd like to do is start by outlining what economists see as the main reasons why we should think about tax reform, why it's something we might need. Then talk about two general approaches to tax reform, then dig a little bit deeper into the main prototypes and end up with a little discussion about what the policy process might actually serve up to us. So that's the plan for the discussion. I'm used to, as Mark noted, teaching undergraduates around here, and they aren't shy about asking questions. And in fact, I don't know if I've ever been able to go for 50 minutes without being interrupted. So if you feel like piping up, that'd be fine. I'll either answer the question or I'll say, can't do it now, talk to me later. But I don't see, if there's something that's not clear or why you should just sit and stew about it. So don't feel free to let me know. Okay, so why do we need tax reform? At least why do I think we need tax reform? I think there are three main problems with the current system. The first is it has a bias against saving and investment. The tax code, with its high marginal tax rates, saving, investment, work, tends to bias decisions against investment, against saving, against entrepreneurship, and this tends to depress growth. And the question is there a way we could collect taxes that would be more friendly to growth? That is, other things being the same, we'd like to have a bigger pie to divide among ourselves. Is there a way, can we conceive of ways to collect about the same amount of tax that would enable us to grow better? That is, in short, the tax system should help enhance prosperity, and I don't think the current system is doing a very good job that way. The next problem is complexity. How many of you do your own returns? Okay, well, you know what I'm talking about. Much of complexity is due to attempts to change behavior through the tax code. Some of it is to achieve certain social goals. They all seem fine in isolation, but what they lead to is a system with enormous compliance costs, lots of tax evasion because no one knows exactly what's going on, and very frustrated taxpayers. Again, more than half of you have actually had to deal with the tax system, so I don't have to elaborate on this too much. I'm teaching this semester an undergraduate course in public finance, and they aren't lucky enough to have had the same life experiences that you have. So I just give it to them, and I have an assignment in which I put together this, a set of facts for a hypothetical family, and say you compute their taxes. And by the way, you're not allowed to use TurboTax. But it's much more effective in teaching the kids what the system is really about than just saying, oh, it's very complex. Trust me. Some of them aren't happy with the assignment, but I decided it's a good learning experience. Well, what are some examples of complexity in the tax system? Well, capital gains, that is the increase in the value of the asset, can be taxed at 10 different rates, all right, depending on whether it's short-term, long-term, what kind of asset it is, a house, something else, 10 different rates. Okay, well you say, all right, that's fine, but that's for people involved in high finance. Well, here's something for people who aren't involved in finance at all in a serious way. There's 5 different definitions of a child in the tax code. All right, so you think, oh, kid, that's a child, right? Well, it depends whether it's for an exemption for claiming the earned income tax credit, whether the kid can file on his or her own. So there's 5 different definitions of a child. There are 20,000 pages of tax regulations. Now you might be thinking, okay, well this is just for upper income people, capital gains and tax shelters. Well, who cares about them? But low income people suffer as well. The most important income transfer, cash transfer program we have in this country is something called the Earned Income Tax Credit, which is a subsidy that people with low earnings can get through the tax code. To get it, you have to file a tax return and claim it, and there are 12 pages of instructions about the EITC. Now think of the population we're trying to reach there. It's no wonder that compliance with the EITC is abysmal. There's people claiming it who shouldn't, people who don't claim it who should. It's because who the hell can understand it? Try and read those 12 pages sometime. There are economists like quantifying things, and the most reputable estimates of the costs of compliance with this miserably complicated system is about $110 billion a year. Wow. That is, if you take what you pay for help with your taxes, plus the instruction books, and then the value of your time, it's probably about $60 billion for individuals and $50 billion for businesses. Now again, I would go to the stake on these numbers. It could be $90 billion instead of $110 billion, or maybe it's $130 billion. But it's a lot of money. And again, the question is, can we do better? We can't do away with taxation. We have to collect taxes to pay for the goods and services that the public sector is providing. The question is, are there ways to do better? So, one goal of tax reform. The first one was to enhance prosperity. The second, to summarize, is that the tax system should be as simple and transparent as possible. We shouldn't really have 5 definitions of a kid. Okay. Third, many people perceive the system as being unfair. Now, this is closely related to the complexity, because since you don't quite know what you're supposed to be paying, at the end you always feel a little bit nervous. You think, even if you've been trying to comply, you're not sure you got it right. And it's so complex that you're wondering, well, maybe the family next door is cheating. Maybe everyone is cheating. Maybe you're the only one who's not. And one tax lawyer I know calls this the cheat or chump syndrome. That if you're complying, you feel like a sucker. And that's just not good in a democracy, and especially a system where we depend to a large extent on people self-reporting. So the third thing is that we want a tax system that should be perceived as fair. So those, I think, are the goals of tax reform. Let's keep them in mind as I discuss various prototypes, various approaches, and you can keep your own mental scorecard about how each possible reform ranks along these criteria. In most general terms, if we're talking about real possibilities for taxation, for running a big government of the kind we have, there are basically two different bases for taxation. Two different ways we decide what's going to be taxed. That's a tax base. And there's two different bases. One is income and one is consumption. And let me explain what I mean by an income tax and a consumption tax. An income tax is levied on wages, salaries, rents, royalties, profits, all forms of capital income, dividends, interest, capital gains. That's what I mean by an income tax. And income is anything that increases your ability to consume. And those are the most forms of income. And personal income, the thing that we have now, the basic workforce of the federal revenue system, we call it income tax, and it raised $892 billion roughly in 2005, or will raise about $892 billion out of about $2 trillion of federal revenue. So you can see the income tax is the main workhorse of our current system. Now, an alternative, if you think of an income tax as taxing an increase in your ability to consume, what is your ability to consume equal to? Well, the increase in your ability to consume is what you actually consume plus what? What you could have consumed but you didn't, also known as saving. So the second possible tax base is a consumption tax, which is levied only when your income or wealth is spent. The key attribute of a consumption tax is that it's triggered by the act of consumption, which means specifically that it is not triggered if you get some interest, if you get some dividends, if you get some capital gains. Is that consumption? Not unless you spend it. Then it's tax under consumption tax. So an income tax taxes you on your potential increase in consumption in a year, and a consumption tax taxes you on the actual consumption. And many economists believe that a consumption tax would be inherently more pro-growth. And the reason many economists believe this, it's not very deep here. Once you understand that a consumption tax that the act of saving does not trigger a consumption tax, the act of receiving dividends, interest, capital gains, does not trigger a consumption tax liability, then it becomes clear, or fairly clear, that if we tax consumption rather than income, we'd have lower interest rates because there'd be more saving, greater investment because when interest rates are lower, businesses can invest more, and higher productivity. Now those are obviously qualitative statements. Economists have done their best to quantify this. That is, if we went from an income tax to a consumption tax, how much bigger might the pie be? And the increase in long-run GDP, gross domestic product, could be as high as 5%. Now that's a lot of money. Right? If you take, right now we have a $10 trillion GDP, increase that by 5%. I can't do that arithmetic in my head, but it's 5 with a bunch of zeros after it. That's a lot of money, and it's a lot of money, well, to do with what society wants to do with it. We could spend more with it publicly. We could return to taxpayers. We could lower taxes. All sorts of things we could do, but it's that the pie is a lot bigger. So we want to take consumption as a base seriously as a candidate for tax reform. At the end of the day, we may reject it, but when you think about the growth possibilities associated with it, you can't be dismissive. Although, again, at the end of the day, you might want to dismiss it, you can't dismiss it out of hand.
Professor?
Yes?
That sounds awfully like a free lunch, though, having this consumption tax and having more growth. I mean, we really don't know that the growth would increase up to 5%. And also, don't you really have to address income inequality, since you can have an economy growing at 10%, but if only 1% of the population gets all the benefit, what good is that for everybody else?
Okay. You raised 3 points, all of which are extremely important and interesting. Right? Let me take them in the order I want to take them. All right? The first is the distributional aspects. Okay. One thing I drive home to my students from the very first lecture in the public finance course to the very last is that fairness is part and parcel of thinking about what a good tax system is. That a tax system that's efficient, pro-growth, economics does not say, oh, fairness, that belongs, let the philosophers worry about that. Okay? Fairness is part and parcel of the economic analysis. So as the talk proceeds, I guess I'm going to put you off a little bit. We're going to talk a lot about the distributional aspects of consumption versus income taxation. And the trick, just to anticipate where I'm going to be, the trick is to see, can you get the best of both worlds? All right? That's your third point. Your second point was we don't really know it's 5%, and the answer is absolutely not. The 5% figure, it's based on sensible estimates of what various parameters are, and again, I would go to stake on 5%. But I think every academic economist who's published in a peer-reviewed journal, I hate to appeal to authority because it makes me sound like a lawyer, has found substantial numbers. Okay. Now, the first point is really an important one, which I'll be quite assertive. Which was, well, aren't you talking about a free lunch? And the answer is, it's not a free lunch in the following sense. If you are doing something really inefficient and stupid, and you stop doing it, then your income will go up. That's not a free lunch, okay? And the contention is that the way we're taxing ourselves now is in many ways very stupid, and therefore we can collect the same amount of revenue and be bigger, and so it's really not a free lunch kind of story.
Understood, but you can still have an income tax that's perfectly simple, like Steve Forbes' income tax, where you throw away all the deductions and whatnot and have a flat rate. You can also have the same kind of system with a progressive rate, but still throw away the book on all the deductions.
There's lots of ways to go, and in fact, I'm going to be talking about them. You're talking about we can have reform within the income tax. We're going to discuss that. It turns out Steve Forbes' tax isn't actually an income tax, and which I promise we'll get to as well. So those are 3 really good points, and I think some of them will address some of them I put you off, but I promise by 9 o'clock I will have addressed them. Any other questions?
You could also tax just wealth.
Okay, another base. One base you can tax is income. One base is consumption. A third is wealth. Now the difference is that income and consumption are measures that are referring to changes in things during the course of the year. Your wealth is the amount you have. And the fact is, if you're thinking about something that's going to be a base that's feasible for funding the federal government, where you're talking about 10% of GDP, I think virtually every tax authority thinks that using wealth as a base is just administratively infeasible. But yes, if I were being comprehensive and listing all the possible tax bases, wealth would be there. And of course, wealth, if we're talking about the local tax system, of course, the system we use here in Princeton, New Jersey, then wealth is a very important tax base. What am I talking about here? Property tax is a kind of wealth tax. Now, a broad-based wealth tax would not only do your house, but would do your furniture, your Persian rugs, your art. Now, as I'm going through this list, you should already be getting a sense that this may be a little tough to administer. That's why it's not. That's why it wasn't on my list. Yes, sir.
You outlined your most important criteria, and you started at the get-go with trying to make it favor growth. But we've been talking for quite a long time, and you haven't said anything so far about impact on different income levels. I hope you're going to talk about that and the way you're.
Yeah, that was exactly this gentleman's third point.
Yeah, the way you're going seems to be on a consumption tax, which is harder on poorer people.
Not a fair guy, don't worry. Okay, I tried to be a little bit careful when I was characterizing the status quo. If you open up your book of 1040 forms, you look at just the cover, it'll say income tax. It's really not exactly an income tax. And here's why. If you believe me, when I was characterizing consumption tax, what's the essence of a consumption tax? The return to saving is not taxed. Now, if you believe that, why is it the case that I'm not willing to characterize what we have, what you cope with every year, as, quote, an income tax? Well, does anyone have a 401k? Does anyone have an IRA? Okay, what's distinctive about those? You tax, your interest and dividends are not taxed. And indeed, about 37% of household assets are wrapped up in these tax-favored savings accounts. So it's really a misnomer to call the thing we have an income tax. What we have is a strange hybrid between an income tax and a consumption tax. Some forms of capital income are taxed, some aren't. The ones that are taxed at different rates. So we certainly don't. This really addresses, again, this is one of these gentlemen's points, that if you want to do reform within the current system, one thing you could do is get rid of all that stuff. But it's really, I don't know whether it's right to call this thing an income tax. I don't know what to call it, except a thing. Now, I've been dealing with consumption taxation in very broad terms. It's accurate but broad, and there are different ways in which one can tax consumption. There's 3 prototypes, and I think that practically every consumption tax proposal that's gotten any sort of serious political play falls into one of these 3 categories. One, and we're going to go through all 3. Number 1 is a national retail sales tax. Number 2 is a value-added tax. And number 3 is a flat consumption tax. And I'm going to talk about all 3. These are 3 different ways of taxing consumption. The first one is a national retail sales tax. And here's the starting point for thinking about this. States, such as New Jersey, raise about 37% of their revenues from the sales tax. Why not replace the personal and corporate income taxes with a national retail sales tax? Think about it. When you go to the store and you buy something that's, you pay a sales tax, is the IRS in your face? No. Do you have to fill out a return? No. Do you have to worry about it? No. They charge you the 5%, you pay it, it's clean, it's easy, and people look around and say, hey, that sounds pretty good. Why not just do it at the federal level? And this has gotten some serious play. For example, Congressman Linder has favored this, Congressman Tozan, and there's a real movement here to basically get rid of the income tax, get rid of the corporation tax, and just replace it with a national sales tax because it seems to work just fine at the state level. So let me tell you about the advantages and disadvantages of a national sales tax. The advantages are the tax is collected by businesses when they sell goods and services, so the IRS need not collect personal financial information. They don't have to know who you are, how many kids you have. The government's nose is out of your business. You don't have to fill out a return. It's a consumption tax rather than an income tax, so it's better for growth. Return to savings, not tax. And so you get better saving, investment, and growth. What are the disadvantages? Well, you have to keep it revenue neutral. All right? It's not fair to say I favor this tax reform over the status quo if I'm not going to raise as much money. Right? You have to make an apples-to-apples comparison. Well, the people who have looked at this carefully, and actually it's not that hard to look at it carefully, that if you wanted to do what people like Linder want to do, which is take the personal income, corporate, and estate taxes, and levy a sales tax, the rate would be at least 32%. Okay? Well, so what, you say?
That's not what you said, but you can say so funny. Well, experience, I'm going to tell you something which is an empirical reality. This isn't like gravity, all right, which is a law of nature. But experience shows that as a rule of thumb, compliance breaks down once rates reach about 10%. Okay? Only 6 countries in the world have ever tried national retail sales taxes at rates greater than 10%. This will be interesting conversation at your next cocktail party. They are Iceland, Norway, South Africa, Sweden, Slovenia, and Zimbabwe. All right? All 6 of them abandoned it. All right? Now, question, well, why? You know, what's so hard about administering a high retail sales tax? Now, again, I'm not saying that 10% is a magic number, but there's 32% is really high. And so what's the big deal? Well, think about it, right? You go to the store, you buy a pair of jeans, and you pay a tax, all right? If you cheat, that is, you don't pay, let's say you pay $100 for a fancy pair of designer jeans, and you owe $5 on it. Who's monitoring it? Nobody. That is, if the seller just doesn't bring it up, the government's not going to know. So you don't pay the $5. You're better off. He's no worse off. Better yet, you could split the difference. You can say, well, how about you give me a $2.50 break, and we won't pay the tax. Now, why doesn't this go on now? The answer is the tax isn't very high. With 5%, it's really not worth it. All right, it's not worth it to cheat. It's cumbersome. You have to start making deals. Your conscience may hurt you. There's always some possibility of getting caught. That's why these state sales taxes can survive, because they're just not very high. Now, when you talk about 32%, the story is different. I don't know if any of you belong to Sam's Club on Route 1. Well, when you signed up for Sam's Club, all right, you may remember that you filled out some forms, or you were invited to fill out some forms. And one of the forms said, are you a business or not? All right, you probably didn't pay much attention to that. Well, the reason you fill out that form is because if you're a business, we don't charge sales taxes on business-to-business transactions, because then you just start piling up the tax. You only want, it's a retail sales tax, so you only sell it when the final box is sold. Well, you probably didn't give it a second thought. If you had a 32% tax rate, you might start thinking, well, how about if I tell Sam that I'm a business? Who's going to know? Well, he may or may not have to report to the government. And after all, I I give some speeches once in a while. I get a little honorarium. I can say I'm a business. Let him audit me for 32%. So it's not mysterious why these things would be pretty hard to administer. And in effect, as far as I'm concerned, it's a deal breaker. All right? I mean, I will go through the rest of my list. But if you can't administer the thing, I don't see what the point is. But the list is too much fun, so I'll just go through the rest of it. One is, it would be unduly burdensome on low-income families, because at least on a yearly basis, low-income families consume a higher proportion of the incomes than high-income families. Now, if you're serious about this tax, you say, no, I can fix that. What we'll do is we'll exempt necessities. Well, what are necessities? Food, drugs, clothing. Well, that's a pretty clunky way to get fairness into your tax system, because after all, high-income people consume food too. There are some low-income people who don't consume much because of other needs they might have. Plus, you get into administrative complexity. For example, if you wanted to be fair, what you'd say is, well, poor people buy their food and rich people eat at restaurants, so we'll tax restaurant meals and we're not going to tax food. Okay, well that sounds good. Now, if like me, you once went into a coffee shop in Berkeley, okay, what you discovered is that if you have your latte, on the premises, that's a restaurant meal. That gets taxed. If they put it in a styrofoam cup, put a top on it, you take it out, it's not taxed. Well, you know, if you have a piece of pie, it's the same deal. If you eat in the restaurant, it's taxed, because that's a restaurant meal. Now, again, these distinctions, they're sort of funny. You know, who cares about whether your latte is taxed? But when it raised 32%, it matters. Okay? Now, Congressman Linder has an interesting idea to deal with the fairness issue. What he says is we're going to send every person in America, man, woman, and child, $3,000 or so. Okay? And that way, if you're poor, the $3,000 will about pay for the tax you would have been spending, you know, paying on the sales tax. And if you're rich, well, you get it too. Okay? And because you're basically financing it if you're rich for your sales. And that's an intriguing idea, but again, I think very hard to administer. You know, who's going to get it? And of course, his whole point, the reason he loves this, is that he wants the IRS out of our lives. Well, when they start sending out $3,000 checks to everybody, they're going to get right back into your life to find out whether you're alive, where you live, and so on. How do you think the states would feel about this? How do you think the governor of New Jersey would feel? Be delighted, right? Say, well, we're taxing consumption. We'd be just love to have you jump into. Wrong. But, you know, the governors would be lighting themselves on fire in front of the Capitol. So it'd be very, very difficult. So I think the national sales tax is probably hard to imagine it actually working. Now, an alternative is a prototype called a value-added tax. And let me explain a little bit about the mechanics of the value-added tax. The starting point for thinking about this is that goods, for the most part, are produced in stages. So if you think about bread, for example, the farmer grows some wheat, he sells it to the miller, she sells it to a baker, the baker makes bread and sells it to a grocer. That's the retail level and it's sold. Now, what I put up here is a simple little numerical example. This column shows the purchases, so we have to start somewhere. The farmer starts from scratch, sells for $400 to the miller mills. I'm a city boy, I don't know exactly what milling is, but somehow they turn it into flour, and he can sell for $700 to a baker. The baker, I know what she does. You know, she hires labor, buys yeast and stuff like that, turns it into bread, sells it to the grocer who sells it for $1,000. Now, at each stage, the producer at that stage is adding value. Okay, you add value to the wheat by milling it. You add value to the flour by baking it into something. And your value added by definition is just your sales minus your purchases of materials, all material inputs. So, for example, the miller's value added is $300, and so on. So far, so good? Yep. Up there, is that all right? Okay. A value-added tax is simply a proportional tax at each level of production on the value added at that level. So, for example, since the farmer's value added is $400, his value added is $80, hers is 20% of $300, which is $60, and so on. All right? And I'm just going to keep track of the fact that if we add up the value-added tax at each level, what do we get? We get 200. Okay? Now, file that information away, press Control-S, and imagine that instead I had said, I'm going to do a retail sales tax of 20%. Okay. If I'd done a retail sales tax of 20%, then how much money would I have collected? 200. 200. Right. Well, that's not a coincidence, because the sum of the value added has to equal the final retail price. Then it has to be the case that a tax at a proportional rate on the value added gets you the same result as a retail sales tax. The moral is very simple. A VAT, which seems to Americans a very exotic kind of tax instrument, they do that in Europe, A VAT is just an alternative way of collecting a retail sales tax. That's all it is. So if you hate a retail sales tax for any reason, you think it's unfair, you like income better, then you have to hate a VAT as well, because they are arithmetically equivalent. Now wait a second. If they're arithmetically equivalent, then why in Europe do they use VATs and not retail sales tax? Put another way, the VAT rates are much higher in Europe than 10%. They range around 17%. What makes this administrable? All right? Well, I'll tell you what makes it administrable. They have a devilishly clever way of collecting it. All right? And I will tell you what they do. They go to Mr. Grocer and say, hi, I'm the tax collector, and we have a value-added tax. But you know what I'm going to do? I'm going to charge you a tax. I have good news and bad news for you. First, the bad news. I'm going to charge you 20% of your whole sales. You say, wait a second, it's a value-added tax. This isn't my value-added. I say, wait, I'll tell you what the good news is. The good news is I'm going to give you a credit against that tax for all the tax that's been paid on earlier stages. But there's more bad news. And the bad news is you're not going to get that credit unless you have an invoice proving that the tax was paid at those earlier stages. Aha, all right. What does a VAT have that a retail sales tax doesn't? It has a built-in self-monitoring system. Okay? And that's why, whatever flaws you may see in this thing, it is administrable. Of course, it's administrable because it exists. Now, I painted too simple a picture of real-world VATs. Real-world VATs are much more complicated than the textbook version because they exempt some goods. In Europe, they exempt food. Some goods are in, some are out there. Some are taxed at different rates. In fact, there are some estimates which suggest that administering a VAT is just as complicated and expensive as administering our mess. But nevertheless, it can be administered. So, put another way, if you're enchanted with the idea of a retail sales tax and saddened by the fact that it's not administrable, then we can rescue it. Okay, and you can rescue it with a VAT. So, what are the advantages and disadvantages? Taxes consumption rather than income. That's good for growth. Reasonably good compliance in Europe, not perfect, not tax nirvana, but it's reasonably good compliance. As with the retail sales tax, the IRS need not collect personal financial information, get the tax authorities out of your face. Okay. Disadvantages. Raises the same fairness issues as a retail sales tax. If you're concerned about the distributional implications of that, you better be disturbed about the distributional implications of this. Requires a whole new administrative structure. Okay, so especially if we keep the income tax and use that as an add-on tax, we have these two things, two monsters instead of one. Now I'm going to, my next two bullet points, one will tell you why you should hate the VAT if you're a conservative, and the other will tell you why you should hate the VAT if you're a liberal. If you're a conservative, and I won't ask you to raise your hands, if you're a conservative, you will view the VAT as basically a money pump for the government and have concerns about taxes being hidden in product prices. Here is an estimate that will turn your blood cold if you're a right-winger. Okay. For every percentage point increase in a comprehensive value-added tax, it brings in roughly $50 billion. Okay, so if you're concerned about the government growing too fast, and if you think spending has been going up too much in the last 4 years, the last 8 years, well, you ain't seen nothing yet. All right, that is a concern that conservatives have. So conservatives have not been excited about this. Liberals view the tax unduly burdensome on low-income families because once they understand that it is the sales tax, then if they have concerns about the distribution, then so you have conservatives not liking it much because they think it's going to expand the size of the government. You have liberals not liking it much because they're worried about distribution. And therefore, it's hard for me to imagine a political coalition for me that'll make this happen. There are any number of times when I've been at tax events where members of the tax establishment, they sort of get you in the corner, drinking their hand, and say, just between you and me, we're going to have to have that. We have these financial needs and for the government, we have to raise a lot of money, we're just going to have that. I've been hearing this for about 20 years. Right? It hasn't happened yet. The last important political person politician to promote a VAT was Lloyd Allman. I don't know, this was during the Carter administration. He was chairman of the Ways and Means Committee. It's a very powerful committee, probably the most powerful committee in the House. It's the only time in history that I know of where the chairman of the House Ways and Means Committee did not get reelected. Again, you can sort of say liberals say, who's left? So again, when I'm going through these prototypes, I always like to say who's supporting it. You have people like Linder for the retail sales tax. When I talk about the flat consumption tax, well, some other characters. Here I have no one. No prominent elected political figure that I know of has been willing to come out and say I'm for that. Okay, third prototype. Virtually from the time I opened my mouth about consumption taxes in this room, I was hearing concerns about fairness. And as I mentioned, those belong in a discussion of the economics. They are part and parcel of the economic analysis. And so the real question is, can you build some progressivity into a tax that's a consumption tax? So in some sense you can get some of both, get some growth potential, get some fairness. Can it be done? Put another way, can you personalize a consumption tax? When you go to the store and buy a spool of thread, your tax doesn't depend on whether you're rich or poor, blind or sighted, or whether you have 3 kids or not. Right? Can we make a consumption tax depend on your personal circumstances? And I would like to talk about a fascinating prototype which moves in that direction. And I'm going to call that a flat consumption tax. And to understand the flat consumption tax, you have to look at it, it's a very tightly integrated system which looks at both business taxes and individual taxes. I haven't been saying much about business taxes here because I haven't really needed to so far, but this is a tax structure that very tightly and elegantly ties together business and individual taxes in a way that gives you a consumption tax with some progressivity, and indeed about as much progressivity as you want. And let me tell you how it works. So there's 2 pieces to this. The business tax, there's the business tax and the individual tax. Let me explain how the business tax works. Here's the tax base. Okay. The tax base at the business level is the business takes its revenues, it subtracts its purchases of goods and services, purchases of material inputs, and then subtracts the wages it pays. Okay? So, your base, okay, take the amount of money that comes in. We subtract, okay, so like if you're the miller, right? We take your sales, we subtract your purchases of material inputs, which in your case is flour. No, the miller gets the wheat. You subtract the wheat, and then if you have some wheat mill guys to turn the wheel, you subtract their wages, and there's some money left. That's your base. Okay, that is taxed at some rate. Let's call it 19%. Okay, that's the business level tax. All right. Now we're going to come back to this, but for the moment, I want to tell you what's at the individual rate. The individual rate, the individual tax, has your wages. Period. Okay? No dividends, no interest. And will build in, say, an exemption that maybe your first $30,000 of wages don't get taxed at all. Okay? So that's the prototype. Now let me explain what it means. But do you get the picture? By the way, when I talk about this, you have your wages, no other junk, and just this big old, this honking exemption of $31,000. What should you be picturing? This is Steve Forbes what? This is the postcard. You fill out a postcard which has your wages, then you subtract $31,000 if you're a family of 4, and then you pay a tax, let's say at 19%. Yes, sir?
Are you saying that if I'm a trust fund kid and I get $10 million in interest a year and I don't work, I pay no tax?
Not at this level, not the individual level. Okay, but that's not the same as saying that no tax is paid on it, as I will now demonstrate. Let's go back. Okay, this is so cool. All right. If I forgot about this, what kind of tax would I have? A base where it's just revenues minus purchases of material inputs. Hint. What is it? It's a VAT. If I didn't have this piece, this is just a VAT. Will we stipulate to that using the lawyer's term? You have to. All right. It's a VAT, but there's a difference because I'm subtracting out wages. Now, what that means is if I have one thing I didn't mention over there, but which should be clear, since I'm only subtracting out material inputs, and I'm not subtracting out the wages you pay, then in effect your wages are being taxed at whatever the VAT is. You may not have thought about it that way, but it's true. Now, what am I doing here? I'm taking the wages out, so they're not being taxed at the business level at 19%. And what do? I move it down here. They're being taxed at the individual level at 19%. What the hell difference does it make who's writing the check? None whatsoever. So the Forbes, this is why the Forbes flat tax is not an income tax. The Forbes flat tax is a consumption tax. The reason it's a consumption tax is because it's equivalent to a VAT, which is equivalent to a retail sales tax, which is a consumption tax. So the Forbes, it's very clever because you might think, ooh, there's wages on your postcard. That wages are income. That makes it look like a consumption tax, an income tax, but it's not because these wages would be taxed anyway under a VAT. So it's close to mission accomplished because what I've done is I basically took a consumption tax, get all those good properties, but by building in the exemption here, what do? Well, I can make it as progressive as I want. If I want a $31,000, your first $31,000, you don't pay a penny. That's not good enough. We'll make it $40,000. Of course, what's the trade-off? I'll have to have a higher rate, but that's a social decision we can make. How much growth we're willing to trade off. Now, what about all this interest and dividend stuff? Well, notice. Another thing that's not being deducted here is interest or dividends. Right? So, if you're a trust estate kid and you're getting lots of money, that money is being generated by a business somewhere. And all businesses pay this tax. So the interest and dividends are taxed up here. And just because you're not writing a check doesn't mean they're not being taxed. They're being taxed, and they're being taxed exactly one time. So it hits that stuff, or at least, yeah. Now let me tell you what the advantages and disadvantages of this thing are. Okay. The advantage is that once you understand this consumption tax, you get all your growth advantages of a consumption tax. Unlike other consumption taxes, like a retail sales tax or a VAT, it can be made as progressive as desired by including an exemption at the individual level. You know what else you can do? If you want to, you can make, I have this sort of the Forbes way, where you just have a flat rate. But you can have the same basic structure and put in increasing rates. So you have increasing rates rather than a flat rate. Now, talking about a flat tax with increasing marginal rates, it's a little like saying jumbo shrimp. You know, it's sort of an oxymoron, but nevertheless, you can do it. And in fact, my late colleague, David Bradford, designed a prototype like that, which he called an X-tax. But the X-tax is basically the Forbesian flat tax with increasing marginal rates. So if you have an exemption at the bottom and increasing marginal rates, well, again, it's a social decision about how much progressivity you want to build in, how much growth you're willing to trade off. So you get your consumption base and you get your progressivity. The basic trade-off, again, the more deductions. In fact, if you decide there's a pressing social need for charitable deductions, you can have that here too. But you know what the trade-off is. The trade-off is going to be the more deductions, the larger the tax rate. Of course, what happens to complexity? It goes up too. Even charity, which I thought was simple, it's not. Deciding what qualifies as 501c3 organization, it's very complicated. But that's a social decision. Probably would need a new administrative structure because this looks a lot like the current corporation tax. So those are the advantages. What are the disadvantages? Well, one thing is it's never been tried, all right? And no matter how good it looks on paper or on the board, you have to be nervous about something that's never been tried. Now, personally, that makes me nervous. I've been in conversations with people who are absolutely convinced, no big deal. That you turn a few switches here, change a few rates there, and you get it. I think it's worth being nervous about. The other question relates to the gentleman's question. It's what in the government we call bad optics. Optics refers to the way something looks. And it's exactly this problem. That I guarantee you that if this became serious, Newsweek would run an article showing you how someone with $1 million worth of interest, maybe $5 million, wasn't paying a cent of tax, and Joe Sixpack, who's making $45,000 is paying more, and isn't that outrageous? All right? And it didn't take me that long to explain this to you. All right, that the interest and dividends are being taxed. They're being taxed. Someone else is writing the check. And by the way, if you don't take that seriously, if your boss withholds money from your paycheck to pay for your income tax, have you ever for a second thought that because your boss is writing the check to the government that you're not paying the tax? No, you'd be pretty dumb if you thought that. The Newsweek people, they just either they wouldn't understand it, or if they did, they figure, well, that's too complicated. So the moral is that the bad optics would make it very, very hard to sell this politically. Yes, sir.
Two questions. One, what happens to tax-exempt bonds and state financing?
Okay.
And the second question is, wouldn't that create a lot of people working as individuals, not as partnerships or reporting corporations?
Okay, two good questions. The first question is, what happens to state and local finance? Let me just develop the question a bit. As you know, under the status quo, state and local governments can borrow at a lower rate because their interest is not subject to taxation, while other kinds of interest, government interest, Microsoft bond interest is. Okay? Now, if no interest is subject to tax at the individual level, what happens to the advantage that the states and localities have? Goes away. We just have, what we've just done is discover another constituency that will fight to the death against this. Okay? Now, my own view is that I think the status quo biases the decisions that state and local governments make. Because basically, with this lower interest rate they have, and this is another topic, but it's sort of an interesting one, given that they have this lower interest rate, it biases them in favor of projects for which they can borrow at this cheap rate. So they probably spend too much on bricks and mortar stuff, on capital expenditures, and not enough on other things. So it's not clear that from a societal point of view would be worse off if they lost their tax advantage, but they would certainly hate it. Now your second point, sir, was?
As an when you say
All right.
private businesses.
Okay, the answer is that this business level tax applies to all businesses, not only corporations, partnerships, but also to sole proprietorships. Okay, so if you're a sole prop, you're filing Schedule C now, you pay tax in exactly the same way. You take your revenues, minus purchases, material inputs, minus your wages, and there you go. So in theory, it should be biasing you in favor of one form of business organization versus another. Yes, sir?
Can you clarify for me how you figure a value-added tax on a service rather than a product?
How do you figure a value-added tax on a service rather than a product? It's practically impossible, and that's why in Europe most services are exempt. And another reason why real-world value-added taxes don't look like this thing on the board. And by the way, you could have also asked me the same question about financial services. All right, we know that the PNC provides you very valuable services in terms of managing your checking account. You don't pay a fee for it, right? What you do is you get some interest rate, which is probably a little bit lower than it would have because they're taking some of it to pay for that. How do you know what their value added is? Beats me. And in Europe, they mostly just throw up their hands and say, this is too tough.
Is that a viable proposal then in an economy that's moving from products to services?
Well, the problem is I don't know of any tax system that does a very good job of handling financial services. So it's not much of an answer, but I know of no prototype which does a good job of handling it, which is it's a problem. But that's just telling you that real world tax systems are all going to be messy and ad hoc in certain respects. Yes, sir. Ma'am, I'm sorry, I can't see.
This to me looks very reminiscent of the way we're financing Social Security. So with what we think the demographics are going to look like, why would this be different? Where you have a few wage earners supporting quite a bit more.
Well, I think one of the key differences is that in Social Security there's an important intergenerational aspect. Okay, it's workers now supporting retirees now. They're different generations. Here it's taxpayers now supporting government now for goods and services that the government provides now. I mean, that's just one important difference.
But on a current pay system on Social Security, you're basically talking about the cost of Social Security right now being paid for by the small pool of wage earners. It looks similar to me.
Well, there's a difference between a wage base, because remember, the Social Security tax is not integrated with the business tax. Okay, Social Security tax is a wage tax, of course, just up to a certain limit, right? Up to what is $90,000. But there's no business tax piece that goes with it. So the essence of this thing is that the business level and the individual are tightly integrated. Yes, sir.
You said it's never been tried, but in fact, the first element of the tax is a value-added tax, which most European countries already have. Are there any that also have a reasonably close facsimile of the wage tax so that you could draw some conclusions from it?
Not that I know of. Yes, ma'am.
The current tax system, there's oftentimes the legislators or policymakers have incorporated into the system tax incentives or tax penalties for businesses. How would that fit into this picture, if at all? And secondly, earlier in your presentation, you indicated that one of the things that individuals that we actually face with the that phenomenon that people feel that they're being cheated with the tax system. Is that actually just a theory, or is that something that's actually been researched?
Okay. Yes, it has been researched. They've done surveys, and taxpayer morale in this country, it's not abysmal, but it's not so great. With respect to tax incentives, the answer is quite simple.
which is you get to subtract purchases of all material inputs. So that means if you buy a machine, you buy a computer, you subtract. That's it. No more special doodads, or for this kind of equipment or that kind of equipment. No more, if you're manufacturing, you get this. If you're not manufacturing, you get that. It's research experimentation. This is totally stripped down. Now, of course, if, the wise men and women in Washington decide that, something needs to be done to stimulate this or that, they can build it in. And again, you know the story. You get more complexity, higher rates, and you have to decide. But the main incentive here is that you get to subtract all capital expenditures. In tax aficionados call it expensing. Yes, sir?
No amortization.
I'm sorry?
No amortization.
Correct. You just subtract it all out. Yes, sir?
Is this encouraging investment and savings simply because of the lower tax rate?
It is encouraging taxation, one, because of lower tax rate, and two, because the basic return to saving interest is being taxed. Even if you had a higher rate, less of it would be being taxed.
But it's being taxed.
Well, it's being taxed, but because you're allowed to expense your capital goods, which is what the interest is financing, at the end of the day, for a normal return, it's escaping. That's hard to demonstrate, but we can talk about that afterwards if you'd like. Yes, sir.
If you remove the mortgage interest deduction and the property tax deduction, what do you do to the real estate market?
What do you do to the real estate market? What I would expect is that if they actually did this, they would phase it in over time, and over time you reduce the demand for housing, and house prices would fall. Put another way, status quo is favoring housing. If you move to a system which is neutral with respect to housing, housing won't do as well. Now, as a footnote, that mortgage interest deduction, you only get if you itemize, and only 30% of the population itemizes. I bet everyone in here does. This is a random sample. So it might be a little less when you think about the national market. Okay, you just identified another constituency. The realtors are very shy, though. You never hear from them.
It seems to me that there are two questions. One is compliance, and the other is the cost of administration. And I just wonder if there's any comparison for the alternatives here as to whether you could expect more compliance and whether the cost of administration would make a significant difference.
Okay. The question is, what would happen with compliance and what would happen with cost of administration? The answer is, if you were able to keep it as simple as this, I'd be willing to bet that compliance costs would go down and evasion would go down and compliance would go up, because it's just easier to see what's going on and who's cheating. But this really leads to a point, and I think I ought to move on here, which was made earlier, let me rephrase a question that came up earlier in the discussion, which is, you're taking an ideal consumption tax and comparing it to a real world income tax, and that's not really fair. Okay. Then either what you should do is say, how would you reform the income tax to make it better? That is, get rid of all the junk there that we were talking about a second ago, or junk up the consumption tax to see what it would look like after it went through the real world political process. So this leads me to my last prototype. I'm now going to move away from consumption tax to income tax. I'm going to call this reform within the current system. Okay. Reform within the current system says, here's what we're going to do. We're going to simplify the code. We're going to eliminate the alternative minimum tax, get rid of a lot of deductions. We can get rid of the state and local tax deduction. We can get rid of mortgage interest. All these things will make things simpler, allow lower rates. We'll simplify the savings provisions. Do you know how many tax-favored ways of saving there are? 20 different varieties. Okay, there's IRAs, there's traditional IRAs, there's Roth IRAs, there's 401ks, 401bs. I can't even list them all. And they all interact with each other. And we could, you know, if you want to get a clean income tax, you can. Most of the deductions and credits would be repealed. I mentioned state and local tax deductions. That costs the government about $66 billion a year. Who knows what the biggest tax exclusion is in the tax code? I've heard home mortgages. No.
Education?
No. It's health insurance. Because here's how it works, folks. When your boss, you know, most people get their insurance through their employer. That's a quirk in our system that came up by an accident during World War II. But we haven't. Now here's what happens. Your boss gives you $100 in wages. That's taxed. If instead your boss gives you $75 in wages and buys on your behalf a $25 health insurance policy, what's the tax on that $25? Nothing. Well, income is income, remember? Anything that increases your potential to consume, you're consuming health insurance. So if we simply said that your boss's payments for your health insurance would be taxable to you, that would raise $112 billion. That'd be very popular, of course. But what I'm saying is that I'm telling you what we need to do if we want to clean up the income tax. That is, if you don't like the complexity of the system, if you don't like the fact that it encourages cheating, that it's not transparent, that the rates are high, I'm telling you what has to be done. Now, at the end, you may decide, okay, I've seen it, I don't like it, I'd rather stick with the status quo. But I'm just say, yeah, you can reform the income tax. And that, and with a clean income tax, compliance would go up, administrative costs would go down. The base broadening ideas, some of them are so politically infeasible that I hesitate even to put them down on paper. In fact, when I worked in the, Dr. Brandon mentioned that I worked in the Treasury from May 1991. I was a deputy assistant secretary, and people were concerned about the deficit, and they said, well, let's have a deficit reduction exercise where everyone's going to come up with ideas for things we could do to reduce the deficit, either cutting spending or raising taxes. And so my staff, came up with a list that included, cutting back on mortgage interest deduction. And my boss, who was the assistant secretary, was a cagey old Washington tax lawyer, he saw a piece of paper and he just balled it up. He said, "You can't even put that on paper." I went to the Washington Post to realize what would happen. I had a similar experience. I was in a briefing with the president, and some tax issue came up, and someone proposed some sort of tax incentive for an issue. I need not mention what it is. And he said to me, well, what do you think about that? I said, well, sir, I really think we should just try and raise revenue with the tax system and not try and achieve other goals. We have other instruments for achieving other goals. He said, well, but even you must be in favor of the deduction for home mortgage interest. And I said, well, sir, I actually don't think it's very good policy. He said, Harvey, keep that thought to yourself. Even I know that's not really helpful. Okay, what are the advantages and disadvantages of reform within the current system? Well, while the current system is highly imperfect, at least we're accustomed to it. Right? Definitely no. Substantial benefits could be achieved.
Incremental reforms may be legislatively practical, particularly if reforms have to be revenue neutral. All right, that is if we're being, we want to get something done, that might be the way to do it. The disadvantages sort of turn the advantages on their heads. Now, it may be nice to be able to do this in an incremental fashion, but if you're a politician, you want to come out and say, I'm bold, I'm in favor of reform, I'm in favor of pulling up this bad system by its roots, well then, reform of the current system, it may not be perceived as sufficiently innovative. Repeal of popular tax preferences would create fierce opposition. One cannot be sure that a reform that emerged from the legislative process would actually be better than the status quo. I mean, I know people within the administration who didn't want to launch a tax reform effort at all, not because they liked the status quo, but they just had this feeling that no matter what started, by the time it came out the other end of the sausage grinder, it might be worse. And so they, those are the advantages, disadvantages. Now finally, let me go through a historical case study of reform within the current system. Because in this case, we actually have some history within the United States to look at. We don't have to worry about Europe or Slovenia or Zimbabwe. We did this in the United States. In 1986, we had a big tax reform act, Tax Reform Act of 1986, whose theme was basically broaden the base and lower the rates. And we went about as far in the direction of cleaning up the tax system, the income tax, as any tax theorist who's practical could have dreamed. We expanded the base, we brought various things into the base, we got rid of a lot of deductions that were there. We lowered the rate from 50% to 28%. Over 70 credits and deductions were reduced or eliminated. Their dollar amount was reduced by 40%. And if you're sort of a tax economist or tax lawyer, this was a very happy event. Now, it wasn't perfect. But that's not, the question isn't what happened in 1986. The question is what happened after it. And the answer is that it unraveled very quickly. That by 1991, the top rate was 31%. By 1993, it was 39.6%. Many new deductions and targeted tax provisions have been added since 1986, including education credits, tax advantage accounts for education, health, retirement saving, special provisions for enterprise zones. And I'm not a political scientist, but I can't help but think that a broad-based income tax with low rates is not a political equilibrium. That is, it's just too juicy a target. So the question, and I don't have an answer to it, but is if you do tax reform, can you build in a system that will lock it in? Because, again, the post-1986 experience has just been very depressing. And this is totally bipartisan, by the way. Democratic presidents, Republican presidents, Democratic Congresses, Republican Congresses, they all see the tax code as a way to give out goodies, but you know the trade-off, right? More goodies means more complexity, lower base, higher rates. So a challenge for people who advocate tax reform is to do it in a way that is not only economically sensible, but that has a chance of surviving over time in the real world political environment. Thank you.
You started out your talk by offering an incentive for a different approach to this. Using growth as an incentive.
Right.
Do you draw a distinction or a differentiation with rising standard of living as opposed to growth per se?
The question is, am I distinguishing between growth and higher standard of living? And I'm using them as synonyms. That, when we grow, if someone's going to get the money, and how it's divvied up, depends on a lot, what happens in labor markets, what kind of transfer system we have. That basically, there's a bigger pie, and that allows some higher standard of living. Do you want to discuss that further?
Well, just to say that it seems to me you could have a rising standard of living, which would affect everybody in this room, with or without growth.
Yes, you could make some people better off and others worse off without increasing the size of the pie. And what I have in mind is a bigger pie, which potentially allows everyone to be better off. Yes, sir.
This may sort of display my ignorance, but the impression I have is that over the last X years, the tax burden has been shifted from the business to the individual. And this seems to me to shift it the other way back towards business. The example that you have on the board. And I'm wondering if that perception is correct, and if it is, how would business react?
Okay, the answer is, if you looked over the long term, say going back to the 50s, what you'd see is the percentage of revenues attributable to the corporate tax going down. Okay. Now, first question is, well, what does it mean? The way that I react to the phenomenon is to say the following, that a business, it's an abstraction that only people can bear taxes. So what we're really talking about is what people were bearing the tax that corporations were paying. Okay? Does that seem too slippery to you? I mean, in other words, okay, well, let me try and argue, let me try and explain what I mean. If you, I don't know how many of you are lawyers, but my understanding is if you go to law school, and what you're taught is that a business is a corporation is a person, right? A corporation can sue, it can be sued, it can enter into contracts. And class repeat, a corporation is a person. Say it 10 times, a corporation is a person. Well, you can say it 10 times and you come out believing it. Well, the problem is a corporation is not a person. Okay? You're a person, a corporation is not a person, and therefore a corporation does not have the ability to bear a tax. Okay? Stockholders can bear a tax. Workers can bear a tax. The people for whom the corporation is buying inputs can bear a tax. But a corporation has no independent ability to bear a tax. So when I think about business taxation, the first thing I think about is, the business isn't some rich fat guy with the diamond stick pin, all right? There are who are the stockholders and who is it affecting, and so I think that what's going on over time is that owners of capital from this part of the tax system have lower liabilities than they would otherwise. But on the other hand, there have been, the marginal tax rates have been going up and down. And so the question is, at the end of the day, what does it look like? Right? That's an empirical question. And let me tell you about some empirical work that's been done. There's an interesting study done by the Congressional Budget Office, which is sort of the Congress's internal economics think tank, which is a nonpartisan organization. And what they did is they said, let's take business taxes and just allocate them to all owners of capital. All right, so you get imputed a share of the corporation tax based on how much capital you own. All right, so if you're Bill Gates and you own a lot of capital, you get a big share of the corporation tax. We're going to allocate it to every single family. Right. Well, what you find on that basis is that, and then you allocate wages and stuff in the obvious way. The wages you pay, the taxes you pay on those we attribute to you. What we find roughly is under the individual income tax, the top 5% of the taxpayers pay about 50% of the individual income tax. And the bottom 40% of the taxpayers pay about 0% of the individual income tax. And that number has been constant, maybe over the last decade or so. So on that basis, I don't see much drama in these numbers. Now, I don't know what it would look like if you went back to the 50s, which is definitely a fair question. I just don't know the answer. But at least in the last decade or so, there hasn't been a lot of drama in the change in the tax distribution, taking into account the business tax in a sensible way. Saying businesses are owned by people, and you ought to allocate each person's share. It's a long-winded answer, but it's a complicated question.
But the other part of that is does this tax shift the burden in any way towards those owners of capital? And
Right.
if so,
Okay.
how do they react?
Okay, I think the answer is that if you took, the answer is going to depend on how you structure the thing, right? Depends on the size of the exemption and whether you have progressive rates. If you took the straight Forbesian kind of approach, which is a flat rate here, what you would find is that people at the bottom would end up paying a little less, people at the top would end up paying a little less than now, and people in the middle would end up paying more. So that's what. So again, I'm not thinking about it as businesses versus individuals. I'm thinking about high income versus middle income versus low income, and that's why people who like this idea but are concerned about distribution try and think of ways to tweak it to make it more progressive. Because again, you can end up, you tell me the distributional pattern you want, and I'll get it for you, okay, at a cost. I don't do stuff for free. But, I can raise the rates here, get you more progressivity, you'll have less growth, but you may be happy to pay that price in order to get a distribution that you find socially more desirable. Yes?
The tax system also affects
One more.
income.
Sorry?
Doesn't the tax system itself affect income? Because if you go back to the 1950s, a typical CEO might make 40 times the average. Today, with the very lower marginal rates, the typical CEOs make it 600 or 800 times the entry-level employees. So the tax system itself affects income in a very efficient way.
The issue is something the gentleman's raising is kind of lurking in the background, part of the discussion, which is that the amount of income itself is a function of the tax system. And by the way, this is how Steve Forbes would have responded. Right? Well, if Steve were up here, and I've heard him talk about this, what he would say is with this lower rate, the behavioral response would be so powerful that people would work so much more, they would save so much more, that there'd be so much economic activity, so much money would flow into the treasury that we could have lower rates for everyone. Okay? That's a logically consistent position. My reading of the literature on behavioral responses to taxation is that it's overly optimistic. Okay, in other words, it's not silly on the face of it. I just think it's an empirical matter. The behavioral responses aren't powerful enough. So Mark is telling me to stop. So
thank you very much.